If you're completely new to trading, charts probably look confusing. But here's the good news, price isn't moving completely randomly. Today, I'll show you the simplest concept that traders use to make sense of the market: support and resistance. Hi, my name is Matthew and this is Focus Charts. So what exactly is support and resistance? In the simplest form, support is a price level where the market tends to stop falling and bounce back up. Think of it like a floor that holds the price. Resistance is the opposite, a level where the market tends to stop rising and pull back down. It's like a ceiling that holds the price from going higher. Before we dive deeper, it's important to understand that support and resistance can appear in two main ways. The first type is horizontal levels. These form when price is moving sideways in a range. You'll often see the market bouncing between the same high and low multiple times. Those repeated reactions create horizontal support and resistance levels. The second type is trend-based levels. In a trending market, support and resistance don't stay flat, they move with the trend. For example, in an uptrend, previous swing lows often act as support, while in downtrend, previous swing highs act as resistance. Now here's something very important. This is just the theoretical foundation. Support and resistance alone is not a complete trading strategy. They are simply points of interest, areas where the market has reacted before and where it might react again. And it doesn't stop with just these simple levels. Support and resistance can get much more complex. Advanced concepts like supply and demand zones, liquidity pools or fair value gaps are basically just more sophisticated form of the same idea. Areas on the chart where price reacts for a reason. And don't worry if these terms sounds confusing right now. We'll cover all of them step by step here on the channel. For now, I want you to remember this. Horizontal support and resistance levels are your starting point. They give you a way to start making sense of the chart, but they're only the beginning of the bigger picture. Alright, let's take a look at the chart so you can see this in action. Here, I have a chart of Nasdaq. Notice these points where the price has bounced multiple times from roughly the same level. If I draw a horizontal line here, you can see this area is acting as a support. Price comes down, touches this level and moves back up. Now look at this other area. Price tried to go higher a few times, but each time it stopped and turned around. That's a resistance level. Here you can see the market is in a clear uptrend. If you connect these swing lows with a trend line, notice how price keeps bouncing from it multiple times. That trend line is acting as dynamic support. Now look at this downtrend. If I connect these lower highs with a line, you can see price is respecting it and turning lower each time it gets close. That's what we call trendline resistance. So while horizontal support and resistance is the easiest place to start, trend lines show you the same principle, just adjusted for a trending market. Both are simply ways to identify areas where price is more likely to react. The more times price reacts at a certain level, the more traders start paying attention to it. And that attention is often what keeps those levels relevant. And don't worry, in future videos we'll dive deeper into why this actually happens, why markets react to this level in the first place. Now here's an important point from my own trading. I don't personally use support and resistance zones as exact entry signals in my strategy. For me, they're more like navigation points on the chart. I'll mark levels like the all-time high or all-time low, because if price is trading near it, I always want to know how close we are. I also highlight the previous day's high and low for the same reason. Let's quickly break down what those terms really mean, because they come directly from the candlesticks you see on the chart. Each candle on your chart shows the story of price during a specific time period. It could be 1 minute, 1 hour or 1 day, depending on the time frame. And here's how it works. The open is the price where the candle started. The close is the price where it ended. And the high is the highest price reached during that period. And the low is the lowest price reached. So when we talk about the previous day's high, it simply means the highest point the candle reached yesterday. And the previous day's low is the lowest point of that candle. It's simple, but it's very important, because once you understand how candles are built, levels like support and resistance or previous highs and lows make much more sense. In theory, this all sounds beautifully simple. Price hits a support, you go long. Price hits a resistance, you go short. Easy, right? Well, not really. The truth is, these levels often won't hold. Price will break straight through them. And the reason is simple. Support and resistance is usually the very first thing beginners learn about. That means a lot of inexperienced traders are watching the same levels and trying to trade them blindly. But if you're just trading every bounce without a deeper understanding, the market will punish you. That's why it's so important not to treat them as magical lines. Think of support and resistance as zones of interest, places where you should pay more attention, not automatic buy or sell signals. Of course, there's a deeper reason why these levels so often fail and why beginners lose money trading them. It has to do with something called liquidity. Liquidity is one of the core pillars of my own trading strategy, and it explains why price sometimes break through obvious levels before making the real move. I'm not going to dive into it today, but don't worry, we'll talk about liquidity in detail in upcoming videos. For now, just keep in mind, support and resistance is only the starting point, not the full picture. Another thing to understand is that these levels are not fixed forever. A support that worked perfectly last month might be completely irrelevant today. Markets evolve, conditions change, and the importance of certain levels comes and goes. And finally, not every level you see is worth marking. If you're drawing support and resistance on a 1-minute chart, you'll end up with hundreds of lines. That's just noise. For beginners, it's much better to focus on higher time frames like daily, 4-hour, or even the weekly chart. Those levels are much stronger, much clearer and easier to work with. So again, don't treat support and resistance as magical lines. They're just zones of interest. Sometimes they'll hold, sometimes they'll break. So let's quickly recap what we've covered. Support is like a floor, a level where price tends to stop falling. Resistance is like a ceiling, a level where price tends to stop rising. These levels can be horizontal, or they can follow a trend line in trending market. And while they are a great starting point for reading charts, remember, they're not magical lines. Sometimes they hold and sometimes they break. And sometimes they fake you out completely. That's why you should treat support and resistance as areas of interest, not as standalone strategy. Use them to orient yourself on the chart, but don't build your whole trading plan only around them. And remember, this is just the beginning. Support and resistance are the foundation, but there are much deeper concepts that explain why these levels work the way they do. Things like liquidity, supply and demand zones, or fair value gaps. We'll cover all of that in future videos, so if you don't want to miss it, make sure to hit that subscribe button and let me know in the comments how do you use support and resistance in your own trading. Or maybe this is the very first time you've even heard about them. Okay, thanks for watching and stay focused on charts.